Hey everyone, before we dive in, here's something really cool. You're listening to an episode created almost entirely by AI. From the script to the voice, this is part of the AI Takeover series by Blockchain DXB, where we explore what's possible when humans hand over the mic to machines. There's little to no human involvement, and that's what makes this episode so powerful. Welcome to the future of content creation. Let's get into it. This episode is powered by Amana, the region's first and fastest growing regulated all-in-one trading and investing app. Whether you're looking to invest in US stocks like Apple or Tesla, or MENA giants like Adinoc or Salik, Amana puts the financial market at your fingertips. You also get access to gold, foreign exchange, ETFs, futures, and commodities. With over 375 assets to choose from, they've got the largest crypto selection in the region. And listen, guys, if you want to build long-term wealth without thinking about it every day and want to automate your investing, just set your monthly budget, choose your preferred categories, and let Amana do the rest. No fees, no lockups, and 100% customizable. Even better, funding your account is frictionless, and funding your account is easier than ever. You can fund your account with Apple Pay, Google Pay, credit cards, instant bank deposits, and even your crypto wallet. No friction, no hassle. And if you get stuck, Amana offers 24/6 real human customer support and personalized sales assistance. Because you're part of the Blockchain DXB community, you get an exclusive offer. Register with the code BlockchainDXB and make at least one trade to receive a $100 trading bonus credited to your account the following month. So what are you waiting for? Download the Amana app now. The link and code are in the show notes. Next up, Blockchain DXB is proud to be the official media partner for one of the biggest blockchain events of the year, the Blockchain Futurist Conference. For the first time ever, North America's leading crypto event is heading to the United States, taking place at the iconic Guitar Hotel at Hard Rock in Hollywood, Florida. Alongside it is ETH Women, happening simultaneously. Expect multi-stage panels, NFT galleries, DeFi showcases, tech demos, metaverse experiences, and more, all under one roof. It's where the smartest minds in blockchain, crypto, and AI will converge. Get 25% off tickets by using the code DXB25. And yes, I'll be there with exclusive live coverage, behind-the-scenes interviews, and spotlight features on groundbreaking projects. Mark your calendars, November 5th and 6th, 2025. Visit futuristconference.com and use code DXB25. Link is in the show notes. Next up, Blockchain DXB has two more interesting partnership news to announce. First up, with Future Blockchain Summit and Fintech Surge 2025. Blockchain DXB is an official media partner of Future Blockchain Summit and Fintech Surge 2025. Future Blockchain Summit is one of the biggest and oldest blockchain summit taking place in Dubai, going back to almost a decade, 2017 to be precise. The event takes place between October 12th to 15th at Dubai Harbour. This is where blockchain meets fintech to redefine the future of finance. 250 plus world-class speakers, 1,200 plus investors, live demos, product launches, and the exclusive invite-only GITEX Digital Assets Forum, all under one roof. From Web3 pioneers to fintech leaders shaping payments, banking, insurtech, AI, and DeFi, this event brings the entire ecosystem together. Startups, this is your launchpad. Get in front of top VCs, accelerators, and industry leaders. For blockchain and fintech companies, this is where connections turn into partnerships and dreams turn into exits. Register today at futureblockchainsummit.com. Don't just watch the future unfold, own your space in it. Remember, Future Blockchain Summit and Fintech Surge 2025. The registration link is in the show notes below, and see you at Dubai Harbour. Second partnership news kicking off from today is with the leading Bitcoin event organizers on this planet. And this year, Bitcoin Asia is taking things to another level. Bitcoin Asia are hosting a massive gathering this August in Hong Kong, and Blockchain DXB is proud to be an official media partner of Bitcoin Asia 2025. Taking place this August in Hong Kong, Bitcoin Asia is the region's premier Bitcoin gathering, where builders, investors, and innovators meet. It's really an honor for Blockchain DXB to be associated with Bitcoin Asia. Now at this event, expect powerful keynotes, bold conversations, and a headlining session with none other than Eric Trump. He will be sharing his vision for Bitcoin's long-term potential, its role in global finance, and Asia's massive impact on adoption, and a lot more. So listen up, guys. From infrastructure to regulation, privacy tools to lightning development, Bitcoin Asia connects global Bitcoin communities and drives innovation across cultures and markets. And as part of this partnership, you can register for the Bitcoin Asia using the code DXB. All the details are in the show notes below. If Bitcoin's in your blood, this is your event. So, register today at asia.btc and don't forget to use code DXB for 10% off your tickets. Bitcoin Asia 2025, Hong Kong is calling. Be part of the future of Bitcoin. Next up, Advanced Media is the largest distributor of professional video, photography, cinema, and broadcast accessories in the Middle East. They represent over 100 major brands, including DJI, Hasselblad, Red, and Rode. The mic I'm using to record this? Sponsored by Advanced Media. But what really sets them apart is their commitment to purpose. People, planet, and prosperity. That's not just branding, it's their actual business model. They've partnered with SAE Institute in Dubai to offer scholarships to students pursuing a bachelor's degree in filmmaking, each worth AED 50,000. They also run regular workshops, training programs, and tech showcases across the region. For more info, visit amt.t, that's amt.tv. Finally, let's talk about something every crypto investor should take seriously: security. And that's where Ledger comes in. Ledger is one of the most trusted names in crypto security. Their hardware wallets, like the Nano S Plus and Nano X, keep your assets safe by storing your private keys offline. That means you're protected against hacks, malware, and phishing attempts that can compromise online wallets. The company is headquartered in Paris and is constantly innovating. Their team works with world-class security researchers and regularly tests their own products for vulnerabilities. It's why Ledger wallets are used by millions around the world. Using a hardware wallet isn't just smart, it's essential. If you're serious about crypto, it's time to stop relying on centralized exchanges or browser wallets. Click the link in the show notes to order your Ledger wallet and support this podcast at the same time.
If you've been watching the markets, you know this week has been, well, something else. We had a huge shift just yesterday, December 10th.
A huge shift is right.
It felt like one of those days where the high-level macroeconomic decisions from the Federal Reserve just instantly collided with what was happening on the ground in the crypto market.
Absolutely. And it's not just the Fed. We're talking rate cuts, yes, but also these massive institutional capital moves in the Middle East and a complete regulatory restructuring in Asia.
Yeah. That's right. And we have a pretty dense stack of sources in front of us today. Everything from macro analyses right after the Fed's announcement to these new regulatory blueprints and corporate filings.
It's a lot to get through. But our mission here is really to go beyond the noise, beyond the headlines.
Exactly. We need to synthesize all of this for you to give a clear, actionable picture of what's happening with Bitcoin and crypto. And I think critically we have to separate the hard market facts from the media narrative.
That's the key. Because the facts right now look overwhelmingly bullish. But the narrative is what drives that short-term fear.
And that conflict is, I think, the most interesting part of this whole story. The goal is to give you the real context so you can see why the market might dip even when the fundamentals are, screaming the opposite.
We're definitely moving past the headlines today.
Okay, let's unpack this. Let's start with the big one, the Fed.
Federal Reserve decision.
Right. They reduced the interest rate by 25 basis points. The new target range is now what, 3.50% to 3.75%?
That's it. And our sources were noting that Bitcoin prices were already starting to move up, even in anticipation of the news.
But here's the weird part. What's so fascinating is the market's emotional response. Despite this move, which is, inherently good for risk assets, the sentiment indicators like the fear and greed index, they're still flashing fear.
Yeah, it bumped up a little bit to 30, But it's still fear. And that right there, that's the definition of the friction we're talking about, the facts versus the feeling.
So let's stick with the facts for a second. What is the fundamental bullish takeaway we should be getting from this rate cut?
Well, the primary signal is a clear shift toward a more accommodative policy.
Meaning easier money.
Exactly. When the Fed cuts rates, borrowing gets cheaper, yields on safe stuff go down, so investors have to look for growth elsewhere. They're incentivized to rotate capital into risk-on assets.
Like tech, AI, and crypto.
And crypto. We know from historical data that these kinds of unexpected early cuts can trigger a pretty significant rally in Bitcoin. Sometimes, 1 to 5% in just the next couple of days.
Okay, that's the textbook reaction. But if the fundamentals are screaming easier conditions, why is the media narrative winning this time? Is there a real risk we're missing that justifies this fear?
That brings us to the nuance. It's not just about the 25 basis points. There's another detail here that's absolutely crucial.
Okay.
The Fed also announced it will start buying short-term treasuries again.
To maintain reserves in the system, right?
Right. And our sources are calling this a lighter version of quantitative easing, or QE.
Hold on, let's pause there for a moment. What does a lighter version of QE actually mean, and why should anyone in the crypto market care?
It means liquidity. It's all about the amount of money sloshing around the global financial system.
It's increasing.
It's increasing. QE, in any form, is the central bank injecting money into the system. And historically, an increase in global liquidity has one of the strongest correlations with Bitcoin rallies.
Because Bitcoin has a fixed supply.
It's a digitally scarce asset. So when the supply of fiat currency goes up, the demand for truly scarce assets it naturally rises. It's basic economics. This policy boosts demand for Bitcoin and, by extension, the rest of the altcoin market.
Okay, so that brings us right back to the narrative conflict. The sources are arguing the media is creating unnecessary panic, just cherry-picking information. So where's the disconnect?
It all seems to center on the labor market. Chair Powell said the labor market is slowing down, which is true. But the deep analysis suggests why it's slowing is what really matters.
And what do the sources say?
The source material claims that the reported weakness in job numbers is, well, it's largely artificial. It's being driven by the Trump administration making large numbers of federal employees redundant.
So the narrative paints a picture of like an organic economic failure across the board.
Exactly.
But the fact, according to these analyses, is that a specific politically motivated government policy is what's causing that job number to drop.
Precisely. The underlying organic U.S. economy is still showing strength in other critical areas. So by framing this as a general failure, the media generates fear. But if you look past that, you see easing liquidity coupled with this politically derived uncertainty.
Which historically is a great recipe for alternative assets.
It strengthens the case immensely. And the connection is simple, really. Easing liquidity and this kind of fragility, it typically weakens the dollar.
And a weaker dollar means?
It means your purchasing power in fiat goes down. So investors look for hard, digitally scarce assets like Bitcoin to protect that purchasing power, to hedge. That's the fundamental law that drives this rotation. And even though Powell didn't commit to more cuts,
Wall Street is already pricing them in?
Yep. They're anticipating 2 more rate decreases in 2026, and that anticipation alone keeps investors leaning hard into risk-on assets.
Okay, that covers the macro shift. So let's pivot from global policy to specific corporate actions, the kind that signal Bitcoin is, normalizing as a treasury asset.
And we have to talk about Vivek Ramaswamy's company, Strive.
Strive has been a huge institutional advocate for Bitcoin.
And their latest move is a major statement of commitment, a $100 million at the market program.
They're selling preferred stock, ticker SATA, to raise capital specifically to buy Bitcoin and other assets. And Strive is already a big player, right? They hold over 7,500 BTC, manage over $2 billion.
They're significant, yeah.
So what exactly is an at-the-market program? Why is that method important here?
That's a crucial detail. At the market means they aren't just selling all $100 million in stock in one big chunk.
Okay.
You're selling it gradually, over time, directly onto the exchange at whatever the market price is. It allows them to bring in a steady stream of capital. Think of it like a drip feed.
Which they then use to buy Bitcoin gradually.
Exactly. It's about steady, predictable accumulation, not a huge single purchase that could shock the market.
And that sends a signal to other institutions, doesn't it?
That's the key. That gradual, cautious accumulation, It screams long-term commitment, it builds confidence, it normalizes the idea that a public company sees Bitcoin not as a speculative gamble, but as a standard, prudent treasury asset.
It puts pressure on other fund managers to justify why they aren't doing the same.
Totally. And before we move on, we should just briefly touch on the consumer side. The Carla Visa card launch.
Oh yeah, offering 5% cash back in Bitcoin.
It seems small, but it's about reducing the barrier to entry.
The activation energy.
Right. The everyday user doesn't have to go open a crypto exchange account or figure out wallets. They use their credit card, and they automatically start accumulating Bitcoin. It makes owning the asset passive and simple.
Agreed. Okay, so we've covered the global economy and corporate treasuries, but for real institutional confidence, you need one thing above all else.
Clear rules.
Yeah.
Clear boundaries.
And that clarity just landed in a massive way from the OGs of crypto adoption, Japan.
Japan's always been seen as one of the most mature crypto jurisdictions, and they're making a major pivot.
From payment law to securities law.
Yeah, exactly. They're moving crypto regulations from the lighter payment law to much, much stricter security laws. They're essentially saying these are investment products, and they need serious investor protection.
That sounds like it could be painful for some startups, but probably essential for institutions. What are the key implications of this?
Well, first, you get much stricter disclosure requirements, meaning anyone running a token sale or an initial offering has to provide granular details on their team, the tech risks, third-party code audits. It just raises the bar significantly.
Yeah.
Makes the market a lot safer for big money.
And second, regulators are getting sharper teeth.
Absolutely. Putting crypto under securities law gives regulators huge new powers to monitor trading, enforce compliance, and this is a big one, to ban and prosecute insider trading.
That is crucial. Institutions will not enter a market where they feel like the game is rigged.
Never. This signals a transparent, controlled environment. Third, they're closing the loopholes for offshore exchanges.
So they can block or penalize overseas platforms that are operating without approval.
Correct. Which pushes domestic capital toward the compliant, regulated platforms. It's a consolidation effort, really.
And finally, taxes.
The discussion is about a potential flat 20% tax on crypto games.
Which, well, nobody loves taxes.
A flat rate provides clarity. For institutions, predictability in taxation is often more valuable than a low rate that's super complex or uncertain.
So why should our listener in, say, London or New York care about the details of Japanese securities law?
Because global precedent is everything. Japan is setting a sophisticated, comprehensive framework that other countries, especially major financial hubs in Asia and the West, will look to replicate.
They're creating the blueprint.
They're creating the blueprint for attracting trillions in regulated capital. What Japan does today often becomes the global standard tomorrow.
Perfect. So let's connect the dots. The macro environment is easing, the regulatory picture is getting clearer.
And now we can look at the next big narrative shift, the one predicted for 2026. Tokenization. This isn't just about buying crypto, it's about using the blockchain rails to rebuild finance itself.
And this takes us to the Middle East, specifically the Abu Dhabi global market, the ADGM.
Which is really positioning itself as a central hub for this.
Yeah.
And the scale of the moves we're seeing there it's just staggering.
Okay, let's start with the foundational work. We have Franklin Templeton, FINREN, and the Adid Foundation.
Right, they've forged a strategic agreement. They're building next-gen regulated investment systems there, exploring tokenized assets, stablecoin use cases.
That's laying the groundwork.
But the heavy-duty commitment comes from Mubadala Capital.
This is an investment giant. They manage over $430 billion in assets.
$430 billion. And they're collaborating with a company called Kaio to explore tokenized private market access.
That number, $430 billion AUM, it just demands your attention. So for the listener, what exactly are private markets and why is tokenizing them such a transformative shift?
Okay, so private markets are things like private equity, venture capital, maybe illiquid real estate or infrastructure investments. Think, a piece of a bridge.
Right. Things that have traditionally been restricted to massive institutional investors because they're complex and illiquid. You can't just sell your share of a bridge on a Tuesday afternoon.
Exactly. So Mubadala and Kaio are trying to fix that liquidity problem using the blockchain. Tokenization lets them take those traditional multi-trillion-dollar assets and break them down into fractional digital tokens. This makes these private market strategies accessible to a much wider pool of qualified investors globally. It increases liquidity, and it cuts down on administrative overhead.
And Mubadala's statement was very clear on this, wasn't it?
Oh yeah, They explicitly said this supports a modern, secure financial infrastructure built on strong governance. This isn't some side experiment for them. This is them moving their core business onto blockchain rails.
In Kaya's reporting, it just underscores the urgency. They noted that over $200 million in institutional assets have already been brought on-chain.
And that's critical. This isn't theoretical. Traditional institutional capital is moving onto blockchain infrastructure right now, at scale. It shows that institutional adoption is accelerating way beyond just buying Bitcoin as a reserve asset.
They're now using the underlying tech to fundamentally reshape how they manage and sell their most valuable assets. Okay, so to summarize everything we've unpacked for you today, we've got a clear signal from the Fed favoring risk on assets. We have corporate treasuries normalizing Bitcoin holdings, like with Strive's gradual $100 million raise.
And you have key global regulators like Japan providing the clarity that institutions have been waiting for.
And the market is reacting with real confidence, isn't it? It's overriding some of that media fear.
Yeah, the sources show staggering total ETF inflows since the rate cut. We're talking $384.58 million globally. That tells you investors are absolutely buying into this narrative of easing liquidity and structural commitment.
And it's interesting, if you look at the last 24 hours, the Ethereum ETF inflows were actually higher than Bitcoin's.
That's right. About $178 million for ETH ETFs versus $152 million for Bitcoin.
Which tells us the rising tide is lifting the whole boat. It's not just digital gold, it's also the layer one infrastructure like Ethereum, which, will be the settlement layer for a lot of these new tokenization projects.
Right. So if you take a step back, if the world's biggest financial players, the ones managing hundreds of billions of dollars like Mubadala, are aggressively using tokenization to bring these multi-trillion-dollar private markets onto blockchain rails.
And this is all happening against a backdrop of easing macro policy and clear regulatory guardrails.
What does that imply about the necessity of Bitcoin, the foundational digital asset in every single institutional portfolio over the next 2 years? It suggests that this is accelerating far beyond just buying the coin. It's about validating and owning the core infrastructure of an entirely new financial system.
It raises a great question. If private markets worth trillions suddenly become liquid and accessible through tokenization, how long before that same liquidity fundamentally alters how sovereign nations manage their own reserves? Something for you to mull over as you see past the headlines this week.